I think we can start now, no? Yes.
Okay, yeah. Yeah, Luis Nelson. Thank you for your presence here. ¿Cómo están, jóvenes? ¿Cómo les ha ido? Espero que todos se encuentren muy bien. El día de hoy pues vamos a estar en una masterclass sobre derivados financieros. Nos acompaña Luis Nelson Romero. Luis Nelson Romero actualmente es profesor asociado en finanzas y chair of the Puri School of Business en Rockford University. Ha tenido un gran desempeño durante su vida, su experiencia laboral. Ha trabajado en Mazda Corporation como Financial Analyst, en Tequendama Bank como Director Board of Trade, en Finagro como CFEO, en Cupo Crédito Bank como Senior Financial Consulting, en Supply Core como International Business, en Burger King como Quality Assurance, en Brew como Senior Financial y en UPS con Capital Business Credit como Country General Manager. Entonces, pues, Luis Nelson, empecemos. Muchas gracias por hacer presencia acá con nosotros. Esperamos que esto pueda ser de gran, eh, de gran enriquecimiento para todos estos estudiantes. Acá nos acompañan estudiantes de la maestría en finanzas, de la especialización en finanzas corporativas, estudiantes del pregrado de ingeniería administrativa e ingeniería financiera de la Universidad EIA. Muchísimas gracias y pues nada, empecemos.
Okay. Miller, my understanding is that you want me to talk in English, and the good thing about derivatives is that most of the terminology is going to be the same in Spanish or English. And I think for your students, it's going to be good that I do everything in English. And feel free to ask questions during the presentation or at the end. I don't know, if whatever you want, maybe at the end. Um, I know that to talk about derivatives is a full class. You know, can you mute the people, Miller? Okay, good. To talk about derivatives is a full class. Today I had just 1 hour and I prepared basic concept about derivatives, and at the end, maybe around 6:45, I am going to do a live sample that you can see how you can apply, for example, a forward in a real environment today in Colombia. Okay, but let me start with a question. Why we are going to learn about financial derivatives? I don't want just to talk for an hour. I like to have some interaction. Why we are learning about financial derivatives? Don't be
Guys,
shy, you can talk.
or in Spanish, no problem.
No one?
No
Okay,
one.
Miguel here.
Yeah,
Okay,
go
I
ahead.
think,
Miguel.
yeah, okay, I can think you can use derivatives because it's another asset, so it's another option to investment, but also you can control your risk using derivatives. That's my understanding.
Yes, your
And
understanding is,
the
yes, go
last
ahead.
one is that you can also speculate like with any other instrument.
Good, thank you. And I like your words. You are going to mitigate your risk and you can also speculate. Good, thank you. And remember that you are studying finance because at the end, you want to do business. I am the chair of a business school and I am teaching my students how to do business. And in order to do business, you need to be able to mitigate the risk, okay? And financial derivatives is going to help you to mitigate the risk. But also, here is a definition for derivatives that is more or less is an instrument whose value is determined by another assets. Okay, every time I'm going to do a derivative in coffee, I'm going to do a derivative in oil, coal, corn, whatever is there, but more or less the value of that derivative is going to depend of the underlying asset, the collateral assets. Okay, and the price is going to be based on future expectations. Remember the crystal ball, because we need to see what's going to happen into the future. What's going to happen with the price of coffee in 6 months? What's going to happen with the price of oil in, I don't know, in a year? What's going to happen with the exchange rate? Everything is going to be based on future expectations. Also, market price volatility, interest rates, and exchange rates overall. For example, what's happening next week? This coming week, the Reserve Bank is going to meet and they are going to decide if they are going to maintain the rates or they are going to decrease the rates. Remember that, for example, in my personal opinion, this coming week, they are not going to decrease the rate. They are going to maintain the same Federal Reserve reference rate. Why? Because the previous month, in February, inflation increased a little bit. It means that Colin Powell, he is going to say we need to maintain the rates. We cannot decrease the interest rates. And it's the opposite that maybe the central bank in Colombia is doing it, because the conditions are a little bit different. And also the gap between the Colombian rate and the United States is very high. Okay. Something that I like to clarify to my students is a derivative is not a product, okay? It's a contract between two parties, a buyer and a seller. Of what? Of a asset that they are going to negotiate in the future market. Okay, and these two parties, they are going to use two instruments, or there are two ways to do the derivative. You can do it in an exchange location, for example, here in Chicago, Chicago Mercantile Exchange, or in Colombia, or you can do OTC. That OTC is over the counter. Over the counter is something is like when you go to a drugstore, you don't need a prescription in order to buy. Whatever you can buy from the counter, you have access to that. Okay, you don't have to have a prescription in order to get the contract or to sign the contract. Remember, it's not a product, it's a contract. It's something that is going to happen into the future, and you can do it through an exchange location or the OTC market. What are the pros and cons? But first, I'm going to start with advantage. When we talk about advantage, and I think Miguel, the student, he was telling us, hey, we are going to use a derivative in order to mitigate or eliminate the risk. When you are mitigating the risk, you are hedging. Okay, why you are hedging? Because you are going to lock the prices. The prices of something that you are going to buy in 3 months, 6 months, 9 months. In that way, you are going to, again, eliminate the risk. Second, and I think, again, a way to speculate is using a derivative. You know, you can leverage your position. You are going to invest, for example, 1,000 in order to invest in something that is going to value 100,000. Okay, you can increase the amount of money that you are going to invest using this leverage, because remember that you are going to put a margin. Normally it's 10% margin for any product, and you put 10%, but you can bid for 100%, but you are investing only 10%. And this is something good because this is going to generate market. This is going to generate liquidity in the markets. Also, when you are managing your portfolio, you are going to have two choices. You can speculate, just buying and hold it for a period of time and sell it and make some money, or the way to diversify your portfolio. Remember that in finance, we normally say that one way to mitigate the risk is to diversifying the portfolio. You can buy fixed assets, you can buy stocks, you can buy currencies, but also you can buy derivatives. In that way, you are diversifying your portfolio. Also, we can see that, for example, the exchange locations, they are integrating right now. For example, in Colombia, you know that you have MILA right now, that is the integration of Chile, Peru, Colombia, and Mexico. The exchange locations, they are integrated. Here in the United States and worldwide, the biggest exchange location for commodities worldwide is here in Chicago, that is Chicago Mercantile Exchange, CME. Okay, this is going to generate markets, and you are going to have the opportunity to do more business because of the integration in one location. In this case, again, CME, Chicago Mercantile Exchange. Also, the good thing about these derivatives is that the underlying assets, remember that is the guarantee that you had over there, the coffee, is going to have more liquidity because you are doing more and more and more business. Is the way that, you know, if you want to buy coffee or do you want to sell coffee, is the market is big enough that you are going to be able to buy or sell at any moment, any quantity, at any time. Also, for normally these points of view, the previous ones is more for financial institutions, but also if you are working in, I don't know, in a corporation in Colombia, if you are working for, I don't know, Johnson and Johnson, or you are working for, I don't know, any company in Colombia, Colombina, for example, if you are hedging your position, you are going to eliminate uncertainty about cash flows. You are going to know in advance how your cash flow is going to behave in 3 months, 6 months, 9 months. In that way, you can do more sophisticated financial planning. And also, because of that, more or less the prices of all the products are going to be efficient, and they are going to be real prices. In that way, the market of financial derivatives is an efficient market. But, you know, they had some disadvantage. Sometimes it's difficult to do some valuations. Sometimes when we have these very sophisticated derivatives, sometimes the valuation of that products are not very easy. Why? Because sometimes the price of the counterparty asset is the volatility can be very high, unknown, is some uncertainty over there, and this is the sometimes that makes these derivatives hard to evaluate. Also, on the other hand, when you are doing OTC, over the counter transactions, you have one risk, and is that the counterparty can do a default. You know, remember that OTC is between Colombina and I don't know, Purina. Colombina and Purina, they are doing X transaction and they are going X derivative. But if something happened to one of the companies, the other one is going to be in troubles. And this is one of the problems with the OTC market. Also, remember that for some derivatives, you have to have the assets, at least one part. In this case, remember I mentioned 10%. This has to be somewhere, and holding there is going to have some cost. Also, I don't know if you remember, but for example, in the financial crisis of 2008, the price of oil increased a lot. And is over there is the factor of sensitivity about supply and demand, and specific financial events are going to affect the price of derivatives. And as I mentioned before, sometimes it's complex to understand that. But I'm going to give you some samples that I'm going to make these derivatives like an easy part to understand, okay? Also, Miguel, he mentioned that when you are a trader, and remember, you are studying finance because you want to be part of this. And how you are going to be able to use these derivatives, more or less, you can use it in three ways. Hedging, and remember, hedging is to mitigate, to eliminate the risk. And the good thing about hedging is that they provide an economic stability. The prices and the commodities are going to be stable, and especially the prices. Why? Because you are hedging um, the future markets. And more or less, you are going to guarantee some prices once you close your derivative. On the other hand, you can talk about speculation, and you can speculate. But when you are speculating, when I was the director of the board of trade at the bank, sometimes you take a position, you had a long position in order to speculate, in order to hold that position, looking for profits. You know, when I am expecting, and I have this phone here, or I have this calculator here, when I am expecting that the prices are going to increase, I am going to buy, in this case, the derivative of the asset. I'm going to hold it. And because the prices are going to increase, then I'm going to sell it and I'm going to make some money. But I am taking the risk because, you know, if something happens, maybe prices can drop and I can lose money. The good thing about the speculation is that they provide liquidity and the market is going to be deeper. It's going to be a strong market because of that. And on the other hand, when you are doing some arbitrages, you know, when you see a gap between prices, and I don't know if you are familiar, for example, with borders. When you are in Cucuta, in Colombia, you can see that some products can be cheaper in Venezuela or some products can be cheaper in Colombia. And people are going to cross the borders in order to go and buy the products that are cheaper on the other side. And when you find that, okay, the border is a little bit extreme example, but in financing derivatives, when you find there is a gap between prices, people are going there and they are going to act in different markets at the same time in order to find these gap opportunities and make profits. The good thing about that is that the market is going to realize that is a gap over there, and they are going to try to match into the future. But again, think that when it's an imperfection, somebody is going to, and this is the reason, when you are in the financial markets, you need to pay attention to Bloomberg, everything that is happening in order to find these gaps in prices, in order to find an opportunity to make some money. And this is the reason I was giving you the example about the gap in prices in any border, for example, in Cucuta in Colombia. Here is some examples. When you are talking, remember that you are going to create a derivative, and remember, a derivative is a contract. But you can do contracts on stocks, bonds, commodities, currencies, interest rates, and indexes. I can do a derivative in one of these products. And remember that what is the main purpose? To mitigate the risk and to guarantee the transactions and guarantee the future cash flows. And when we talk about derivatives, more or less, I think in Colombia, the first two are the most popular. Options, sometimes you can do. Swaps are not very common, but when you are going to see future, forward, options, and swaps. This is the types of derivatives that we have. When we talk about future, a future contract is an agreement to buy or sell an asset on a future date. And normally when we talk about future is a standardized product, okay? For example, you say, okay, I am Colombian and we are going to sell Colombian coffee, okay? And I'm going to do these transactions through Chicago Mercantile Exchange. And the Chicago Mercantile Exchange is going to say, okay, Luis, You want to do a future in Colombian coffee, but you need to define the characteristics of the product. Okay, and what are the characteristics? First, coffee. Second, Colombian. Third, oh, okay, be careful. I'm talking about one contract in Colombian coffee, one contract of Colombian coffee. Again, Colombian coffee. How many bushes? Normally 500 bushes. Green beans at the Miami port in September. I'm going to say the coffee, and you see the example, is Colombian, okay, it's coffee, Colombian, 500 bushes, green beans or toasted beans, whatever, where Miami port, September. Everything is standardized and everything is predefined, okay? For forwards, forwards are future contracts that don't take place in an exchange location. I cannot do the forward contract in Chicago Mercantile Exchange, okay? Because it's over the counter, it's between two parties. It's between this company A and company B. And each forward contract is customized, is tailor-made, is for that specific company based on the needs. Options, we are going to have two types of option, a call option and a put option. And the buyer of the stock option give you the right to buy or sell something, but they are not obligated to do it. Once I have the expiration, I have the maturity day of the option, I'm going to decide if I'm going to exercise the option, yes or no. And the other party has the obligation to do whatever I decide. And swaps, that is the last one, normally is using to hedge interest rates, but you need to have more or less the same business, but in the opposite position in order to do the swap. Swap is when you exchange something for something that more or less they have similar characteristics. Now I'm going to go a little bit deeper in the concepts. Again, when we are talking about forwards, remember forward is something that is customized, is tailor-made, is based on your needs, is based on the specific commodity that you are doing. For example, forwards are very common for currencies. You are in Colombia and I need to buy Colombian pesos or I need to buy US dollars. In order to buy, for example, now that from the previous Super Bowl, that we have the commercial about avocados. When you are dealing with avocados, you are sending avocados from Colombia to the United States, and the buyer in the United States has to pay you. When they're going to pay you, you are going to agree on a specific amount of money. And normally it's not going to be a round amount. It's not going to be $100,000 or $500,000 or $1 million. It's going to be maybe $825,522 with 58 cents. You know, when you had this amount of dollars, you is not a standardized amount. Is something that has to be customized. And this is the reason currencies, normally you use forwards to do currencies, normally, because in the future market you can do currency also. But in that market is going to be a standardized amount. And also with the forwards, you can customize the quantity, you can say the quality and the delivery day. When do you want me to pay? Are you going to pay me 30 days, 60 days, 90 days? I don't know, 120 days? You can decide in the forward market. Again, you are going to use the OTC market, that you don't use a centralized exchange location. And normally, these forwards, you can do it for agricultural products or again for currencies. And normally forwards is company A with bank C, okay? It's a corporation with a financial institution that normally is a bank. Who is taking the risk? Normally the bank is taking the risk. Not only for the variation of the prices, but also because of the risk of the default of the other counterparty. For example, I was reading some news in Colombia. We had Muebles and Accesorios, and I think Colchones Paraíso, they filed Chapter 11. And if you had business with them, they are going to have a default because they don't have the money to pay. Now, this is forwards. Now I'm going to talk about future. When do we talk about the future, remember also it's a contract that you know that you are obligated to buy. I'm going to the buying part. Is buying or sell. To buy, to purchase something in a specific day and a specific price. Okay? The good thing about future is that they allow to speculate. You know, we are going to speculate and you can have a long or short position and you are going to use those in order to leverage your position and to make money. Okay, remember that every time that you are going to speculate in that market, you only have to put the 10% and you can speculate with the 90% with the other part. And this is the good things about this leverage. But for some companies, they don't want to speculate. They just want to hedge and prevent losses or to set the future cash flows. In order to use futures, you have to use an exchange location. Remember that this is going to be is going to be a standardized market and is well regulated. Everything is regulated. Let me ask you, because I'm talking too much. Finance students, what is a long position or what is a short position?
A short position is when you think that the stock is going to have a downwards trend, so you think that it's going to go down, and a long position is when you think that the stock is going to go up.
Yes, yes. Long, you buy it now because you are expecting that the prices are going to increase and you are holding the position. Good. Short position, you sell something that you don't have today, but you are selling that. And the day that you are going to exercise the maturity day, you are going to buy that day because you are expecting that the prices are going to drop. I think it was Miguel again. Miguel, very good. You had a very clear understanding about long and short position.
In this case, Juan José Londoño Herrera said.
Oh, sorry. Thank you. Okay, Juan. And
Juan José.
I saw Juan Jose. I saw a lot of Juanes over there. Okay, this is the long and the short position. Here is sometimes people get confused about forwards and futures. And here is, I have this table about the definition, but more or less I highlight some of the main points that differentiate, for example, the transaction. Okay, the structure, more or less remember that forwards is between the two parties. But when you are doing a future because you are using a standardized location, for example, Chicago Mercantile Exchange, you have to pay a margin, an initial margin. Okay, when are you going to negotiate? Remember, OTC for forwards, futures, you are going to use a location. Market, the regulation, forwards, more or less, is just between the two parties, me and the bank, negotiating what are going to be the conditions. For future, everything is, the government is going to regulate the markets. Who is going to guarantee? And I think this is something that I like about this table. For forwards, you know, it is just the parties that they agree in something. In the future market, you are going to have a clearing house. A clearing house, okay, somebody knows what is a clearing house for the future contract in an exchange location? That somebody knows? What is the main function in a clearing house? Go ahead. Go ahead.
In Colombia, yeah.
Yeah, in Colombia.
Third party using as a market.
I couldn't hear well.
David, can you repeat, please? David.
Okay. A clearinghouse is, remember that you have to hold, if I am doing contracts in coffee, I have to put at least 10% of that in the market. And it's like when you are doing a deposit in any bank. X amount of money goes to the central bank. And the central bank is going to hold it. If something happened, they had at least, I don't know, 5% of your money or 2% of your money. That is the encaje. The clearinghouse more or less is the same. They are going to hold X amount of the position for the people that are negotiated. Remember, you are going to pay a margin or you are going to put X amount of coffee or whatever. But the clearinghouse, they had the position, they had assets, and if something happened, the clearinghouse is going to pay. Okay, if remember we have company A doing the business and we had bank B and something happened and you are using a future market, if somebody fell and is doing a default, the clearinghouse is going to pay for the transaction. Actually, in Colombia, I think maybe.
Cámara de riesgo central de contraparte.
Okay, but the Cámara Central de Riesgos in Colombia, maybe 15 or 20 years ago, it broke. And they need to close. And this is the reason you see that is they had a different name. I think it was Bolsa Agropecuaria, and now they had a different Bolsa Mercantil is the name today. They changed the name not because they want to be like a better name and to rebrand the company. No, it's because they were doing some negotiation with cows and this and that. And the moment that somebody default, they try to say, okay, but we have the cows here. And no cows were there in the ranch that they mentioned that the cows. They say the clearinghouse in Colombia, they went to, I don't know, X location in Colombia and they were counting the cows. But what happened, they say, okay, in this ranch, they had 1,000. In the other ranch, they had 800. In the other ranch, they had 2,000. And they say, okay, you have the cows, but what happened? At night, they were moving the cows from one ranch to the other ranch. And when the transaction fell, it's supposed to be like 10,000 cows, and it was just a couple thousand. And the clearinghouse paid, and they broke the Colombian clearinghouse. Okay, how about the risk? Very low, because if something happened, the clearinghouse is going to pay in the future market. The futures, remember, you are going to have the margin. If you are losing money, they are going to say a call margin. You know, if I am investing in oil and the position that I have, long or short position, I am failing and I am losing the money, they're going to say, hey, Luis, you lost the 10%. Are you going to put more money or you are going to liquidate your contract? And this is going to say, hey, Luis, this is a call margin. They're going to call me in order to increase the margin or to liquidate the position that I have. Maturity, you know, for forwards, it's a specific. For futures, it's something that you can, how, what is the expression? You can move. The expiration day, normally it's standardized. If you check, it's a specific month, a specific day, a specific time. How you are going to, for the future market, remember that here in Chicago, a lot of people are speculating. And when you buy too many contracts of something, in order to eliminate your position, you have to buy the opposite. In that way, you cross the buying and selling positions, and you eliminate your position. You are doing the opposite in order to eliminate the position. Again, the contracts I explained with the coffee. Colombian coffee, green, 500 bushels, Miami port, a specific day. And more or less, all the future contracts are IPOs in the primary markets. Okay, here I had like 20 minutes. Here are the formulas for future markets, how to do the calculations based on the short position or long position. But I'm not going to talk about these formulas at the moment. Now I'm going to talk about the options. Basically, the option is like an insurance. It's like when you buy the insurance for your car. If you had an accident, you have the option to use your insurance car. If it's a small accident, maybe you say, I'm going to fix the car and I'm not going to pay any extra. If it's a major accident, remember, you pay a premium in order to have your insurance, and you are going to use your insurance, and the insurance company is going to pay for the accident. Options are going to be the same. You are going to have two types of options. You have the call option or put option. The call option is the right to buy something. Remember, you have the right to buy something, but not the obligation. For put option, you have the right to sell something, but not the obligation. The counterparty have the obligation to do whatever you decide. And options in that sense are good. And sometimes are getting popular and popular. Normally, when you are calculating options, you are going to have three main calculations. What is the break-even point? What is the profit? And sometimes you need to learn how to calculate the premiums, because sometimes it's like, I don't know, 4 cents per every contract, or sometimes it's like 0.4% of the contract. Sometimes it's a percentage, sometimes it's money-wise, the premium that you have to pay. Again, this is the theoretical part. Remember, life is beautiful. Now, I am going to do a live. Okay, let me show you. We were talking about, let me show you this. This is a call option. Okay, when we are talking about a call option, more or less, here is a sample that I have for a call option. You know, what is the spot price? And remember that the spot price is the price that is today. What are the characteristics of the contract? In this case is oil, and one contract of oil is 1,000 barrels of oil. Here is the premium. You pay 80 cents per barrel for each contract. Here is the strike price, and remember the strike price is the future price, the price that is going to take place in 6 months. And here I have to provide the spot price at the maturity, the price that is going to be in 6 months ahead. Okay, normally when you are doing a call option, you have to identify these main points. If you are going, what kind of option you can use when you have this example? You need to decide if you are making money or losing money. Here, you are losing the premium that you pay here in this part. And then in the second part, you can see all the profits that you can make. Identify three main concepts that they are using for options. Out of money, that is more or less when you are losing and you are losing the premium. At the money, that is the strike price, or in the money, that is the profits that you are doing. Okay, the break even, here is the information for the break even. Remember, it's going to be the strike price plus the premium. That more or less after $55.80, you start making money. Whatever the price is higher and you are going to exercise your call option, you are going to make money. Remember, the premium in this case is given is 80 cents per barrel. And here is how you can calculate the total profit for one contract in oil using an option, a call option. This is for call. For a put option, more or less is going to be the same terminology, you know, the spot price, the contract. Let me check something. This contract is about the stock auctions. Normally, when you are doing stocks, you are doing one contract, normally is 100 shares of whatever you are negotiating. Here is a percentage, it's not 80 cents, it's 0.8%. Okay, it's the strike price, the maturity day, and the price in the maturity. You see the graph, more or less, when you are doing the opposite, and in this case, you are doing here a put option, and remember, you are the buyer. Normally, when I'm teaching my classes, you are the buyer, you are the investor. Because remember that you can do on the other side. You can do, it's going to be a put option, and maybe you are the seller. You need to be careful because you need to be clear about the role that you are playing. Here is, remember that you are selling. And if you are selling when the prices is lower, you are going to make money. And then you just pay, or you just lose the premium that you pay. Okay, this is an example for options. Here is samples about the futures. I'm not going to spend too much time, but maybe later with your finance professor, you can talk about that. And here is a forward. And again, I think forwards are very common in Colombia. And more or less, you are going to find gaps. You are going to find opportunities in order to make some money. But for this case, I want to do a real life example that we are going to build together. Finance students, what is the exchange rate today? $1 equals to how many Colombian pesos? Or TRM? USD against COP. One US dollar equals to how many Colombian pesos? What is the TRM? I'm going to put TRM.
3,908.02.
Okay, 3,908.02. This is the exchange rate today. Sorry, my handwriting, let me make some room here because I am writing like crooked, and this is my handwriting is horrible. Okay, this is the exchange rate for today. Oh, remember, here in the United States, we don't use the dot, we use the comma. Okay, 3,000, 908 with 2 cents. Okay, what is this is information number one. Information number two, what is the Fed, the Federal Reserve Bank reference rate? The interest rate in the United States. What is the rate? Reference rate in the United States. The central bank, the Fed rate. Come on,
5.5?
5.5. Remember that gringos are very 5.5%. Here in the United States, normally, every single central bank, they had just one reference rate. And I normally use 5.5, but here in the United States, between 5.25 and 5.50. If you go, for example, and let me show you guys, if you go to Fed funds rate, and this is investing.com, you are going to say, hey, Professor Romero, but the federal funds interest rate is 5.33. And Miller, my finance professor, he was telling me that central banks, they have the rates is 5, 5.25, 5.5, 5.75. Why is 5.33? Is because they have 5.25, 5.5%. Okay, and this is the behavior. For example, this graph, I like this graph because they show you the history of the United States. I am not happy that 2001 is not here, but we can see the financial crisis here. We can see the COVID here. You know, interest rates are telling you about the history of the economy, about the history. Okay, last question. What is the reference rate of the Colombian Central Bank? Colombian Central Bank. What is the reference rate in Colombia?
12.75.
12.75. Here we have it here. And again, remember, 12.75. And see that in Colombia makes sense. 12.75, 13%, 13.25. 13 point, see, they moved 25 basic points. 25 basic points. But remember that here in America, everything is different. We say 12.75. Okay. Finance student, what is the investment opportunity that you can see with this information? You can make money. And you can use a derivative to mitigate the risk, zero risk, and make money. Who wants to do that? I want to do that. How can you make money with this information? Real life, real time, real example. Come on, finance students, we have 8 minutes to make money.
We can borrow at the United States rate and then move the money to Colombia and invest in Colombia at a higher rate.
Yes. And you are, yes, 100% sure. You are missing something. How you are going to mitigate the risk or eliminate the risk?
You can mitigate the risk via a forward, making sure that you have a way to sell the Colombian pesos and buy the US dollars in the future in order to know exactly what the price you got. And that way you can limit the risk.
Yes, yes. What is your name?
Nicolas.
Nicolas, you are 100% right, and you are going to make money, my friend. Okay, I'm going to do a forward contract, and I'm going to buy X amount of dollars. Okay, what's going to happen with the exchange rate in, I don't know, 6 months? What's going to happen with the TRM in 6 months? How much is going to be?
You mean just for the example?
Yes.
You can put 4,000, for example.
I think it's too high. I was checking the behavior of the exchange rate in Colombia, for example, this year, and it's very stable. Oh, I didn't put the graph, but it's very stable. I think 4,000 is, okay, somebody else.
No, the 3,800.
Okay, I hear 3,800. Okay, good. See, we have the two sizes. Going very high to 4,000, go down at, and
I'm counting that the also the rate here is going down and United States also going down in 6 months a little bit. So that's
yes.
why I think is going down the exchange rate.
Okay, okay. It depends on yesterday or the day before, I read somewhere that somebody was predicting that in the short term, the exchange rate in Colombia can go to 3,800, but maybe in a few years it's going to increase again. But normally, if you call, you are in Medellin, you have to call Banco de Colombia, and they are going to quote you. I'm going to be up a little bit. I'm going to say 3,940. Okay? How much money are you going to make? Or how many? Remember, this is a forward contract for 6 months ahead. 6 months ahead. Okay? How you are going to make money? Do you remember the formula to calculate interest? And I teach my students, this is a kindergarten formula. Okay, go back to high school. If you are borrowing money, what is the formula to calculate the interest that you have to pay?
It's 1 plus the interest rate elevated to the time, the 6 months.
Yes, 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 yes. But I want a more simple formula. Okay, I'm going to give it because I have just few minutes, less than 5 minutes. Normally, and I call this kindergarten formula. And for futures and also for bonds, you can use this without any problem. Interest is going to be equals to capital with K. Remember that it is with C, but in finance, we use like K as a capital times the interest as a percentage times time divided by 360. Okay, this is the formula that we are going to use. Now I'm going to do what's going to happen in Colombia. What's going to happen in Colombia? Oh, sorry, no. I have to start in the United States. What's going to happen in the United States, USA? In the United States, you are going to borrow, and we are going to borrow USD. We are going to borrow $1 million. And we are going to do it for 180 days, 6 months. And the interest, I'm just going to use the Fed rate. I know that this is not a commercial rate. The banks are going to increase. They are going to make money because this is the basic rate. But I'm going to use the Fed rate, 5.5%. And you need to find what is the future value. Okay, this is in the United States. If here is my calculator, and I'm going to apply the kindergarten formula, 1 million times the interest, 5.5%, times the number of days, 180, equals divided by 360. Remember that these transactions are 360. And more or less, you have to pay 27,500. It means that the future value, capital plus interest, is going to be 1,027,500 USD. This is the amount of money that you have to pay in 6 months when you borrow money here in the United States. What's going to happen in Colombia? In Colombia, okay? you are going to move these dollars to the Colombian market, and you are going to get Colombian pesos, COP, Colombian pesos, and you are going to multiply the exchange rate times 1 million, and you are going to get 3,908,020,000 Colombian pesos. You are going to do the math. Here I'm going to do the calculation here. 3,908,020,000. Okay, let me check all the zeros. It looks fine. Oh, and I'm going to put the information here. And I'm going to invest for the same amount of days, 180 days. The interest, I'm going to say that I'm going to invest in a test, and they are going to pay me 12.75. Remember, I am using the central bank rate just to see the gap between the interest rate, the opportunity that is there. I'm going to multiply that amount times 12.75%, that is the Colombian reference rate, times 180 equals divided by 360. And this is the interest, 249,136,275. And I'm going to add the principal or the capital, 3,908,020,000. And I get COP, Colombian pesos. Every time that you are doing international business or international finance, you must identify the currency that you are working. 4,157,156,275 sorry, Colombian pesos. This is Colombian pesos. Now I have to see if I am making or I am losing money. I'm going to do it in blue, the transaction for the forward. Remember, we said that the exchange rate, FX, exchange rate, right now is 3,908 with 2 cents. And in the future, we are expecting that the TRM is going to be $3,940. Okay? Using the future, and remember, I am doing an N equals to 180 days. I am using a forward contract. Forward contract that is going to mitigate the risk. Forward contract. And my forward contract, I just call the Board of Trade at Bancolombia and say, hey guys, I need for 6 months, I need to buy 4,157,156,275 Colombian pesos, and I need to buy the equivalent in dollars. How much are you selling me? And they are going to give you this quote. Now with that information, I'm going to divide it by 3,940 in order to find the dollars. Now in dollars, USD is going to be 1,055,115.81. Okay, this is the amount of dollars in the future. And now I need to find the difference between dollars and dollars. And I'm going to discount my debt in the United States, 1,027,500. 1,700,500. And finance students, you are going to make a profit going to, okay, I'm going to write, I don't like to write in red, but the profit in US dollars is going to be 27,615 dollars with 81 cents. Who wants to make money? And remember, this is money that you are making, zero risk, because you had a forward contract that is going to guarantee the price. You just need to have a credit line here in the United States. And I'm using real data, real exchange rates, real reference rate in the United States, real reference rate in Colombia. And this is something that is going to stimulate that somebody maybe can invest in Colombia. I know that is regulations about short investments in Colombia, but more or less, this kind of transaction is going to help that the US dollar be stable in Colombia in at least for a couple of months. Okay, I am open for questions.
Thank you, Professor Romero. Just a question from my side. Have you had experience working with the mercantile exchange in Colombia? And do you think it works even with low liquidity and not so many participants?
Yeah, this is the main problem. And remember, I was the director of a borrow trade in Colombia for a commercial bank, and we were managing the portfolio and also the exchange rate position for the banks. And yes, it's a big. It's hard to do business when you don't have enough liquidity because you don't have enough buyers or sellers. Yes, it is. It's harder, but you can do it. And this is the reason, for example, right now, with these kind of transactions, you can do also synthetics in Colombia. Remember, I don't know if you hear about synthetics. Yes, no.
Yes. Yep.
Okay. When I was a banker in Colombia, I was supporting a company in the Caribbean part of Colombia, and it was the opposite. It's a Colombian company that needs money, and they say, okay, maybe you can borrow the money somewhere else. You can put everything here. You use the resources here in Colombia in Colombian pesos, and then you pay for that. More or less is the ability to be open to create this kind of opportunities. But opportunities are there. You just need to start exploring where are the gaps that you can make money, or be careful. If you are working for, I don't know, Nutresa in Colombia, and you are in the finance department, your function over there is not going to do to speculate to make money. If you are working in Nutresa, Nutresa pays you as a CFO or financial director in order to guarantee cash flows. And you are going to use derivatives in order to guarantee a specific cash flow for your company, not making money speculated. Good. More questions? Did I
Nelson,
answer your question?
okay. I have a question. How do derivatives impact the efficient liquidity the financial market?
I think derivatives are good supporters of liquidity and supporters of financial markets. It's a way to do business. And it's a way to do business mitigating the risk. Remember that, for example, Ecopetrol or these big corporations, they are selling the oil today, and they are selling the oil 6 months ahead or 9 months ahead or a year ahead. And yes, is a supporter of the financial system in Colombia or anywhere. I'm going to stop sharing. What else?
Just a follow-on question. Do you know
Yes, go ahead,
of
Nicolas.
companies in Colombia that are not using the Colombian Mercantile Exchange, but instead hedging using the markets in the US, for example?
My understanding is that your next guest speaker is the right person to answer that question. I understand that Miller invite Juan Recio, and he's a broker. He used to be here in Chicago. He's in Miami right now, and they are doing this. And I think this is a good question for him.
Okay, thank you.
You're very welcome. And he's an expert on that. He has been doing this for like 25 years. But my answer is going to be yes.
Thank you.
You're welcome.
No more question.
Hey guys, couple recommendations. First, try to be open. Try to be open to do business. Remember, you are in a business school. You are studying finance. You need to be open to create, to perform, and to do business. Okay, and especially I think in Medellin, people are very business oriented, and this is going to be important. And for this kind of conference that is in English, don't care, financial instruments, the terminology is going to be the same in English or Spanish. A derivative is the same in English and Spanish. A forward is the same in English. An option is the same. A future is the same. OTC is the same. Don't be afraid of English. Accommodate, try to understand the key elements of the financial terminology, and you are going to be comfortable in English or in Spanish. And Miller, thank you so much for the invitation. We start a little bit late, and this is the reason I like 11 minutes past.
Luis Nelson, I am grateful for your participation in here for this masterclass of financial derivate. Thank you so much. Thank you for all. See you.
Okay, thank you for the invitation,
Thank you.
and thank you for giving me the opportunity to talk to your students. Thank you, guys. Bye-bye.
Thank you, Luis.
Bye-bye. Thank you very much.
Bye, everyone. Thank you.
Bye-bye.
Thank you.
Bye, thank you. Bye, thank you. Thank you.
Bye.